Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, welcome to This Week Through the Noise. My name is Ray Heung, a senior investment strategist within our Seattle office. And in this week, I'm very happy to be joined by Audrey and Ray, our head of asset allocation in the Seattle office. So bond volatility has been one main topic recently, and especially if we're talking about long bond yield, they were squarely in the focus. Of course, fiscal concern and how to fund government deficit in the developed world, inflation impact as service inflation seems to be sticky, tariff headline, despite not having the same impact as before, all of these actually contributing to the bond yield higher. However, market seems to turn a little bit more dovish after last week's job report, followed by a weak PPI and inline CPI print in the US. So Audrey, the latest numbers show almost no job growth, right? And with unemployment now at a 4-year high. At the same time, inflation looks contained. So I guess, can you tell us what is our view on the Fed decision next week, especially in light of the data? Are we expecting no cut, 25 or 50 basis points?
Well, the slowdown in US labor market has been sharper than most expected. The month of August only saw 22,000 new jobs, and revisions actually showed June actually slipped into contraction, which is the first time since the pandemic. So overall unemployment rate has risen to 4.3%, above the Fed's long-term equilibrium rate, which is a rate flag potentially. With inflation still stuck at around 3.1%, but not accelerating, the Fed do have room to ease, and our base case is a 25 basis point cut at the upcoming meeting, followed by at least another 50 basis point of cuts before year end. And for markets, this is important because lower rates reduce the pressure on financial conditions. And you combine that with the strong earnings outlook we have for AI-driven technology, this basically sets up the risk assets for support over the next 6 to 12 months.
Thank you, Audrey. So with the 25 basis point cut view that we have, would it be upsetting the market to the extent that the US government bond could potentially sell off after the announcement?
A 25 basis point cut is a most likely outcome in our view. Markets have fully priced it in, with only about 10% chance of a 50 basis point cut. So net under this scenario, we do expect the likes of AXJ equities, emerging market local currency bonds, these two asset classes should benefit as the US dollar is likely to also weaken marginally. We will also use the opportunity to add to 5 to 7-year maturity US dollar government bond bucket if the US 10-year Treasury yield rises above the 4.25% mark.
I see. Do you think there's a scenario that the Fed may give us some surprise, and what are the implications for the market?
Sure. I mean, if the Fed were to cut by 50 basis point and in a hawkish way, meaning that it's framed as a proactive move but still relatively data driven, it could actually have the same positive impact as per our base case, especially if inflation continues to behave. On the other hand, if Powell only cuts by 25 basis point but delivers hawkish commentary, that could trigger a short-term pullback in equities and potentially a bounce in the dollar as well. And then, of course, there is this very low probability of a dovish 50 basis point cut. And if the Fed does that, then markets might worry that it signal potential political pressure, and ironically, that could actually push long bond yields higher and the dollar lower, which is a combination that is likely to unsettle risk assets, at least temporarily. So the key takeaway for us is, likely a 25 basis point cut next week, but investors should stay flexible because how Powell communicate in terms of the path forward will also matters just as much as the size of the cut.
Yeah, thank you for that elaboration. Let us turn to Europe for a sec. France has been in the spotlight after another political upheaval. What are the implications for France because of this France political uncertainty? Is this impact on the European equity bonds and the euro?
So President Macron has appointed a loyalist, Sebastien Lecornu, as PM to steady the ship. But the reality is France still faces a political stalemate. And that makes fiscal consolidation difficult, presenting risks to the markets. But history have also shown Europe does have the tool to manage this kind of episodes. If you recall, after the last sovereign crisis, the Eurozone has built a stronger institutional framework, and the ECB also stand ready to support with in terms of liquidity if needed as well. That also means that systematic risk to the market is unlikely, even if France's fiscal picture looks rather messy. And for investors, the opportunities are quite selective. So if you think about French bonds, French bank bonds typically sell off in these periods of stress, but we've also seen credit quality improving over the last couple of years. And history suggests they tend to rebound once the dust settle. So it will be one area that will be comfortable to add on dips. For equities, Euro area stocks have given back much of their outperformance since the start of the year, and political headlines weigh on sentiment. But that said, valuations are now more attractive, trading at a 24% discount to global equities versus an average of around 14%. So that gives us a more balanced risk reward profile when it comes to euro area equities. Now, as for euro currency, we expect euro dollar to remain range bound with a slight bullish bias, potentially trading between 1.145 to about the 1.183 range. The drivers here are twofold. One is the ECB is near the end of its easing cycle, and the second is a softer US dollar as as Fed cuts approaches.
I see. Now, Japan is also another market focus lately. Obviously, because of Ishiba, the prime minister is stepping down, and the LDP leadership is having a race right now. So, how might these political development affect the yen and potentially also on Japanese equities?
So clearly, the markets are watching very, very closely in terms of potential developments because the new PM could shape fiscal and monetary policy expectations. And right now, the former Internal Affairs Minister Sanai Takachi is leading in polls. And if elected, a relatively dovish preference for monetary as well as fiscal policies are likely to add pressure on Japan long maturity bond yields and potentially weaken the yen as well. So we expect US dollar yen to likely stay range bound, but with a slight bearish tilt. And US dollar yen key support remains at around 145.8. In terms of equities, it is a bit more nuanced here. Fundamentals are improving. We've got corporate reforms, pretty solid growth, and inflation are also supporting corporate profits. So those are all positives. But if the new PM drives the yen stronger, then FX headwinds may start to offset or mitigate the earnings story. So we keep a relatively neutral stance when it comes to Japanese equities, with the market likely to remain quite fluid ahead of the full LDP voting coming in early October.
Thank you. Let us move to commodities for a sec. Gold obviously has been making new high. So I guess what is the outlook for gold? Probably including silver and oil.
So gold finally broke out after August week payrolls confirming rising growth risk. And we do expect gold price to continue trending higher, and that is likely supported by Fed cuts, ongoing geopolitical risk, as well as central bank demand. So pullbacks towards the $3,500 per ounce mark could be an interesting buying opportunity, and we are targeting gold to be priced at around 3,675 over the next 12 months or so. Silver should also benefit, but take note that it is more volatile given its tie to industrial demand. And then oil, meanwhile, we do expect price to remain largely capped given the ongoing oversupply, even with the occasion geopolitical spikes.
Maybe the last question from me on Korea has been one of the market's bright spots. It's actually breaking 52 weeks high for the time being. Is there any more room to run higher?
So Korea has rallied strongly on AI tailwinds as well as policy support, corporate reforms. We initiated this as an opportunistic idea back in June this year, and now it is up by around 16%. With valuation now back to their historical averages, we do believe that it is opportune for investors to consider taking profit, and hence we are planning we are going to close the trade, even if the rally can still continue for a bit longer.
Okay, thank you. Thank you, Audrey, for all the sharing. That's all the time we have for this episode. Thank you all for listening in, and we'll see you in the next episode of Through the Noise. Bye now.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.